I recently sat in a consultation with a client of mine, John. He's the CEO of a large engineering company who said, Hardy, I've just sold a property and I'm sitting with the cash and I'm not sure what to do with it. Normally, I'm quite an aggressive investor, but right now, Trump is unpredictable, there's instability in the GNU, and what really concerns me is the high level of the stock markets. The S&P 500 is sitting at all-time highs. The JSE is almost up 40% over the past year, and also sitting at levels that we haven't seen before. Everything I'm seeing online suggests that we're in an AI bubble. The warning indicators all say future returns are likely to be poor. I'm only 5 years away from retirement. Is this really a good time to be investing? And here's the thing. I know I'm not the only financial advisor getting calls like this. I know there are a lot of South Africans, especially people approaching retirement, who are concerned. So in this video, I want to do two things. First, I want to show you what's really going on behind this fear, because it's not only about markets. And secondly, I want to give you a framework so you know when to ignore the noise and when to act, especially if you're close to retirement or already retired. If you're new to this channel, welcome. My name is Hardy Swart. I'm a certified financial planner and managing director at Family Wealth Custodians. On this channel, we help South Africans make better decisions about retirement, investments, and tax, so you can live with clarity and confidence, even when markets get messy. If you find value in this video, please do us a favor. Subscribe to the Family Wealth YouTube channel and share it with someone who might need this. And as always, a quick disclaimer. Everything in this video is intended for educational purposes only. It does not constitute personal financial advice. Your circumstances are unique, so please get professional advice before making major financial decisions. What John had been seeing online is that compared to history, stock market valuations look extremely high. A common measure used to assess this is the Shiller-Cape ratio for the S&P 500. Now I know this is US data and not South African. But the reality is that South Africans don't invest in a vacuum. If the US sneezes, global markets catch a cold, and that shows up in your portfolios, our currency, and our confidence. So, on the one hand, John is looking at data that doesn't look great. But what's making him even more uneasy is the narrative that comes with it. The dominant story of 2026 is AI, a small group of tech giants, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla are spending hundreds of billions of dollars building data centers and infrastructure through a complex web of deals that can make it look like they're simply passing revenue between one another. Money is being made, but it feels like the people selling the shovels are just selling them to each other. The big question is whether there's actually any gold. Will this spending translate into meaningful applications and profits anytime soon? If not, the fear is that markets have run too far ahead of reality and will need to come back down to earth. That's the narrative that really got its teeth into John. And given what we've seen in the past, it's easy to understand why. But what if there's another explanation? Yes, valuations are clearly higher than they were historically, but if you look at the data over time, you can also see a trend. Since the 1980s, valuations have been drifting higher and higher. That raises the possibility that something structural has changed, that higher valuations might be here to stay. Over this period, financial literacy and access to markets have increased dramatically. Hundreds of millions of people now understand the importance of long-term investing. Apps and index funds have made investing easier than ever. With more money consistently flowing to the markets, prices may simply be higher as a result. Then there's central bank policy. Since the financial crisis of 2008, we've seen central banks and governments support markets in ways we haven't seen before, bailing out banks, buying assets, and injecting liquidity where needed. The knowledge that central banks are willing to step in may act like an insurance policy, making markets feel less risky and potentially justifying higher valuations. There's also been a major shift in how retirement risk is allocated. In the past, defined benefit pensions were common. Companies promised employees a guaranteed income for life, which placed enormous long-term liabilities on that business. Over the last few decades, we've moved away from defined benefit pensions towards defined contribution schemes. These are cheaper for companies and shift the investment and longevity risk onto employees. As a result, many large companies today are far less exposed to pension rate and related risks than they were in the past. Those are three powerful forces that could be contributing to structurally higher valuations, and they may continue for decades. I share this not to say that markets are cheap, but to make an important point. There is always another narrative. The same data can be interpreted in very different ways, and a compelling common sense story, especially when delivered confidently, can be incredibly persuasive. The truth is, I don't know whether these factors fully explain why today's valuations are so high. Maybe they do, maybe they don't. But this highlights something crucial. Getting invested today is easy. Staying invested is harder than ever. We're surrounded by emotionally charged narratives, amplified by algorithms designed specifically to push the most extreme viewpoints. When I see comments like, I'm selling all my US stocks, or I'm getting out of the JSE, this is 2000 all over again. My thirst for it isn't about markets, it's about what content that person has been consuming. Nobody wakes up thinking that way. Those beliefs are absorbed from elsewhere, often from people whose incentives aren't always that clear. Markets are notoriously difficult to predict. If you've ever found yourself feeling certain about what will happen next, that's a sign to pause, audit the information you're consuming, and deliberately seek out a different perspective. That's exactly what I wanted to show John. Yes, CAPE ratios are high, and historically they've been linked to lower long-term returns. But the key question is whether they can be used as a reliable signal to get out of the market. There's been a lot of research on this. One well-known study looked at over 100 years of US market data, comparing a simple buy and hold strategy with a valuation-based timing strategy that adjusted market exposure based on CAPE levels. The result? Mixed. Over the full period, the timing strategy produced slightly higher raw returns, but with higher volatility. Once you adjusted the risk, the outcomes were almost identical. And in the second half of this period, the strategies were effectively the same. Crucially, these results didn't even account for the additional trading and leverage costs that a timing strategy would incur. The explanation is simple. Valuations can remain high or drift even higher for years or decades. Any strategy calibrated on what used to be normal would have generated premature signals to exit the market. So the takeaway is this. In the short term, CAPE is not a reliable tool for market timing. Over very long periods, 10 years or more, valuations may influence expected returns. That suggests it's sensible to assume more modest future returns. But that's very different from trying to time exits. And it's also worth noting that high valuations are largely a US phenomenon. Many other regions, including parts of Europe and even South Africa, are trading at far more reasonable levels. So when I spoke to John, we focused on what we can control. First, diversification. He's not invested in one country or one sector. He's invested globally across industries, sizes, and regions. Second, assumptions. When we built his financial plan, we didn't assume a 10% annual return or more. We stress tested the plan using conservative figures, and it still worked. And finally, time horizon. Although John plans to retire in 5 years, most of his money, including his cash, needs to last for decades. The real question isn't what markets will do over the next year or two, it's where they're likely to be 20 years from now. By investing globally, he's not betting on a single country or trend. He's betting on the long-term growth and ingenuity of humanity. And that's not a bet I want to be against. That said, Investing a large lump sum can be emotionally difficult, even for experienced investors. So, in John's case, because he was feeling nervous, we agreed to phase the money into the market over an extended period of 6, 12, or 18 months. Not because we expected it to improve returns. Statistically, it probably won't, but psychologically, it helps. If the markets fall, he gets to buy at a lower price. If they rise, his existing investment do benefit. I remember when I first started investing, markets were at an all-time high. It was around 2005. I told myself I'd wait for a pullback. Instead, I sat on cash while markets kept climbing. I suspect many investors can relate. Now, let's zoom out, because John's fear is not just about markets being expensive. It's about where he is in his life. With the headlines we've been seeing in South Africa over the past few years, load shedding, political uncertainty, rising taxes, stubborn inflation, global conflicts, and volatile markets, both locally and offshore, it's not a surprise that many South Africans approaching retirement feel unsettled. And recently, we've had a noticeable increase in people reaching out with very similar concerns. Should I delay my retirement because markets are at an all-time high? If I'm already retired, should I be spending less? What if there's a potential downturn, and is it going to be different? What if my money doesn't last? These are all reasonable questions. And if you're asking them, you're not being irrational. You're being human. But here's what experience has taught us. After working with thousands of retirees, South African retirees, over many different market cycles, some people are worrying far more than they need to, and others are far more relaxed than they should be. So let's go through the framework. Why does volatility feel so different in retirement? When you're still working, market volatility is uncomfortable, but rarely dangerous. If markets fall while you're earning an income, you'll still be receiving a salary. You're often still contributing to your investments, and you have time to wait for markets to recover. Retirement is fundamentally different. Once you retire, your investments stop being a long-term growth tool and start becoming an income-producing engine. You're no longer just an investor, you're a withdrawer. And this creates a risk that many people underestimate, and we call this sequence of returns risk. Sequence of returns simply means that the order in which market returns happen matters more than the average return, especially in retirement. Imagine two retirees, both retiring with, let's say, 10 million rand, both drawing the same income, and both experiencing the same average return over a 30-year period. One retires into a strong market with good returns early on. The second retires just before a market crash and several weak years. Even if the long-term average returns end up being identical, the outcomes can be dramatically different. Why? Because withdrawals during early market declines permanently damage the capital base. You're forced to sell assets at depressed prices, leaving fewer assets to benefit from eventual recovery. This is why the first 5 to 10 years of retirement are often the most critical. Let's say you retire with 10 million rand and plan to withdraw 400,000 rand per year, a 4% withdrawal rate. If your portfolio delivers a smooth, steady return of, let's say, 10% annually, the maths works. But markets don't behave that way. Returns are volatile. Some years they might be strong, others are painful. And if those painful years show up early, the damage can be long-lasting. This is why blanket rules like markets are down, cut spending, or markets are down, delay retirement are often wrong. The correct response depends on context, not headlines. A 20 or 30% market decline feels catastrophic, especially when the media amplifies fear. But a market fall on its own does not automatically mean you need to take action. The real questions are, what is my withdrawal rate? What is my margin of safety? And how flexible is my plan? Over time, most retirement plans fall into one of three broad categories. The comfortable plan, where withdrawal rates are low and margins of safety are high. Even severe market events are unlikely to force spending cuts. These retirees generally don't need to worry about markets at all. The hidden risk here is underspending. sacrificing experiences and memories unnecessarily. The next is the lean plan. People push withdrawal rates higher to retire earlier or maximize lifestyle. This upside is more income now. The trade-off is a higher probability that spending will need to be adjusted drastically later on. This can work, but only if flexibility is built in. And then finally, the sustainable plan. This sits in the middle. Reasonable withdrawal rates, strong probability of success, and a willingness to adapt if necessary. This is where most well-designed retirement plans should aim to be. When adjustments are needed, they are usually subtle and not dramatic. One of the most effective tools is the dynamic retirement income plan. Instead of automatically increasing income every year with inflation, retirees might consider skip or reduce increases after poor market years. Resume increases once conditions have improved. These small changes often go unnoticed day to day, but they can dramatically improve sustainability over time. We also monitor withdrawal rates relative to starting levels. When they drift too high, modest adjustments brings plans back in track. This approach is far more humane and far more effective than drastic cuts. Rules and models are essential, but life matters more. If a family has planned a once-in-a-lifetime trip, we don't cancel it because a spreadsheet doesn't agree. We look at priorities, flexibility, and other alternatives. And we also look at the bigger picture. Retirement planning is not about rigid rules. It's about informed choices. Markets will fall. Inflation will surprise us. The rand will remain volatile. None of this is new. What matters is not avoiding volatility, it's planning for it. If you know what bucket you're in, what your margin of safety is, where you can adapt if needed, then market volatility doesn't have to derail your retirement or steal peace of mind. And that ultimately is the goal of good retirement planning. If you found this video helpful, please do us a favor, like and subscribe to the Family Wealth YouTube channel. It genuinely helps more South Africans find this kind of practical retirement education. And comment below, if markets fall 20% this year, would you change anything? Yes or no? And if you want help stress testing your retirement plan properly with the right withdrawal strategy, tax planning, and guardrails, you can book a complimentary exploration call with one of our professional team members. The link is in the description below. Thanks for watching. I'm Hardy Swart. This is Family Wealth. Keep investing into your future.